Howdy, Jacob here. Today we're looking at Celestica in the electronic equipment instruments and components industry. 5.5 billion market cap on just under 6 billion enterprise value. Revenue is up about low single digit year over year, low single digit per year over year for the last 10 years, with a single digit gross margin, high single digit gross margin, low single digit operating margin. So pretty small margins here. Abysmal return on invested capital, mid single digits. Balance sheet shows 370 million cash on hand with 17 million short-term debt, 589 million long-term debt. Okay, that's about 400. Nah, that's pretty small. About 200 million net debt, and they produce essentially 200 million a year for free cash flow. So we're not terribly concerned with that balance sheet. They have great production of free cash flow, good amount of cash on hand in comparison to their debt. So we're not concerned there. Their use of free cash flow is a little bit of share repurchases, maybe 15% of capital allocation, a little bit on acquisitions. It's not every year, but when they do, it's a pretty hefty sum. And then a bit of reinvestment back into themselves. So I think we've seen enough to make some assumptions here. Revenue growth side, I'll probably stick with what I've been seeing the last 10 years. 3% there. Pretty low margins. I don't need anything. I don't think it deserves any sort of premium from that perspective. For margins here, I'd like that free cash flow is a little bit higher, but I mean, it's still 2 and 3%. And share change, they do buy back some shares. 1% would be about 50 million. It doesn't even say they're doing enough to offset stock-based compensation. Not really sure how share count's going down. I guess maybe they're not completing these options, but from what I'm seeing, I think they can offset stock-based compensation, nothing really more. Don't pay a dividend. So with these assumptions, drop 76% before you get the return I'm looking for here. So for me right now, it's a business with very low margins, and their cost of goods sold really just take over so much of their revenue. I mean, they have very solid production of free cash flow and net income, and it's been positive the last 10 years, which you can still get a great business, low margin. I mean, look at Costco. They're single digit operating margin side, mid to low single digit operating margin side. Fantastic business. So for me right now, though, I just don't see anything that's screaming that it's, fantastic company. And so with my assumptions being maybe a little bit on the conservative side, it's going to be a price point that's going to have to fall a bit more for me to really have to look after this stock. So I'm just going to be looking at other companies in the meantime. Hope you enjoy the video and have a great rest of your